Hi, I'm Seth Freudberg. I'm the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader of SMB Capital's Options Trading Desk. So today I'd like to talk about a misnomer in the options world, which is to call the kind of trading that we mainly teach in the options tribe and we mainly trade on our trading desk, calling that options income trading. I've always had a problem with that term because I think it misleads people unintentionally, I'm sure, and I think that it gets people into the wrong frame of thinking when they're trading. And sometimes words matter, and the way you think of things and conceptualize things matter. And I think this is an example of that. So let's talk about sort of how this came about. One of the most popular options strategies, actually the most popular options strategy, is the covered call. You're long stock, then you're short a call above the market or at various locations relative to the price of the stock. If the market makes, if the market rallies, usually your shares get called away. If the market just sits there, you'll just make money on your covered call. And if the market goes down, you lose money on your stock, but you make money on your covered call. So some people like to think of a covered call as a way of making some income on their portfolio of long stocks, which is, most people's investment portfolios are heavily involved in long stocks. So if you do sell a covered call across a broad spectrum of the stocks that you own, then most months you'll receive some income from owning those stocks because the covered calls will normally expire worthless. If they don't expire worthless, the stock goes up. Your shares get called away, but you still made income from collecting the cover call premium. So people got in the habit of thinking of that as creating income from your portfolio, and it does in fact do that. So to call that income options trading, I think is legitimate. That'd be a fair name for what that is. But then there's another form of income trading, which is the what I call creating option structures, an iron condor, a butterfly, a calendar, a double diagonal, a broken wing butterfly, and all the other many strategies that are out there. Those strategies, to call them options income trading, I think is much more of a stretch and actually is a mistake psychologically for the trader. So let me explain why I'm saying this. Let's take a look at one of the most common and easily understood option strategies, which is the iron condor. Most iron condors, if you enter them, say 60 days from expiration, a couple months away from expiration, and you enter them with a low delta. Those of you who are options people know a delta means the probability of the short options expiring in the money. If you enter at low deltas on your short put and your short call of an iron condor, you should, the vast majority of the time, make money on that trade because you're so far from the market, and the market normally trades inside a reasonable range. And so if, for example, in the example I'm showing right now, we had the S&P 500 was trading at 2095. We got into this trade and we got $2,400 of premium. We were short the 2200 call and we were short the 1920 put, and the market behaved itself, stayed inside the range of the put and the call, and we got about $2,200 out of the trade if we had waited till the end of the day. Never having touched the trade the entire time, by the way, just put it on and take it off when it expires, you would have made the full credit of $2,400. At this point in the day, it was about $2,200, but that would have all evaporated by the end of the day. That would have been a very typical month. But every once in a while, it doesn't go typically, and the market breaks out of a range and ends up in another range. And then you would not make a profit in that month. On the trade that we're showing on this slide, the market was just coincidentally just around at 2095. In this case, we would have received $2,600 of income. We were short the 2210 call in this case, and we were short the 1900 put in this case. And for this particular trade, the market broke out of its range, and by the end of the trade, the market had actually sold off below the short put. It was a big sell-off. It was the sell-off in early 2016. The market sold off below the short put, and the trade was a big loser. The loss would have been about $7,500. So it's hard to call this trade an income trade. The previous one you might have called an income trade where you made 20 some $100, but this trade you're not going to call an income trade. So to call it income trading implies that you will make money on these trades every month, and then you can live off of that, pay your mortgage, go to the groceries, and go to the ball game, whatever you want to do. But if you lose money in a certain month, then you cannot pay your groceries, you cannot pay your mortgage, and you've got a problem if you haven't planned for that. So looking at it in another way, if you expect to get a 30% return on your options income trades, which I think is a reasonable long-term number for this type of trading, you're not going to get it 2.5% per month, nice and evenly. It's probably more going to be like this, losing in some months, winning in other months. It will add up to 30% in both cases, but you get there in a much more rocky way in the real world than you do in the hypothetical world where you're just pocketing 2.5% of your capital as a return every month. So why is this important? Why am I harping on a relatively obvious point? And the reason is because people who go into options income trading make the assumption that they're going to make money every month. This is wrong. You are not going to make money every month. And therefore, people get into a mindset, well, if this is going to be my way of making a living, then every time my trade gets to the amount of income I expected to take out of the market every month, I'm going to close the trade. Well, that's quite flawed, because if you do that, then what do you do in the losing months? Starve? Get evicted from your home? That is not, that's not good planning. Instead, you've got to organize your personal cash flow so that you expect to have months where you do not get any income from the market, where in fact you lose money in the market. Your overall annual return should be consistent with your return expectations. If it's not, there's something wrong with your strategy, there's something wrong with your trading, there's something wrong. But presumably over time, what you expected to happen should happen. And if it does, that doesn't mean it's going to happen in a nice, neat, flat pattern. So you have to have a plan. You have to understand, first of all, if you're going to get a 30% return, it's not going to come in evenly over 12 months. It's going to occur over, it's going to not be absolutely consistent like that. Rather, it's going to occur unevenly throughout the year. So you've got to have a source of cash flow if you are going to be trading for a living that gives you the ability to pay your bills and so forth during the months where you have not made money. And conversely, and most importantly, it allows you to not dip into the size of your trading account. If you start going into the capital in your trading account to pay your bills, you're never going to catch up because you've reduced the capital base off of which you are trading. So that is absolutely a losing proposition. So this is a video about thinking through your life and thinking through your trading as a business. Every business has cash flow needs. This is a business that has cash flow needs. For example, many department stores, retail stores lose money many months of the year, and at Christmas time, at the holidays, they make back that money. So they have to have a form of cash flow during the months where they are losing money so that they can be there to cash in around the holidays. That is a business. Trading is also a business that has lumpy incomes. and you have to plan for that in your trading. Otherwise, you'll get into a very dangerous mindset, which is, I better close the trade now because I've made my nut this month. And what you then have done is given yourself no room to absorb the inevitable losses which will occur in certain months of the year when the market is trading outside of a range. So don't close your trades when you've achieved your income goal for the month. That is not the way you should think. You should not really have a monthly income goal. You should have an annual return goal that when you divide it by 12 meets your monthly income needs and what you are setting up as your goals as a trader. So please think of that. It's a big mistake that a lot of people make. It's a simple money management issue that people forget about. And if you do, you will find yourself in a cash flow crunch, which is entirely unnecessary if you had just planned ahead. So thanks very much. I hope that you take this seriously and consider your planning for your trading before you go any further in trading for a living. So thanks very much, and we'll see you next week.